Well, hello, everybody, to a special webinar titled COVID-19 Process Versus Prediction, a look back at decision-making during an unprecedented time and how to prepare for a potential second wave. My name is Jeff Porter. I'm Chief Investment Officer here at SBSB. And as always, I'm joined by my friends and colleagues, Gary Lyons and Walt Knockett.
Hello, everyone.
Hello, everybody.
So there's a number of reasons why we wanted to do this webinar today. And one was to consolidate in one place the key educational points that we were making in communication pieces during the downturn in February and March and April, et cetera. Because so much of what we were talking about was timeless. It was looking back at market history. It was talking about the functioning of the market. And what we really believe is that if we can demystify the market, help you understand it a little bit more, that increases your comfort in uncomfortable times. So we see this as kind of like a playbook for you and us. We can draw upon it whenever the next downturn is, or if there's a hiccup this winter. And we just think it's a good resource for you. So there was a number of different topics that we discussed a number of months ago and that we'll be discussing again today and expanding upon. One of them was the importance of knowing yourself prior to market extremes, kind of understanding the emotions of investing. Another really important topic, the difference between the economy and the markets. We discussed sentiment, how bullish or bearish the market is, or expectations of market participants, and how they can be just as important, if not more important, to actually knowing what the future holds. We talked about previous bear markets, and clients who have been with us for a while know that we're always throwing out the statistic 35%. In the average bear market, markets fall 35%. And what happened this time? Markets went down 34% and change, stopped, and then busted higher and never looked back. So how important was just that little data point in decision making back then? We discussed understanding market returns, kind of what makes up those returns and why stock markets recover. Why is that every downturn there's been a recovery and that stocks move from the lower left to the upper right? And then also, taking all this information and putting a plan into action, regardless of kind of the scenarios that may present themselves. So this is all that we're going to talk about today. So I'm going to take this first one here, which is all about knowing yourself and knowing how you may react in market extremes, not only in downturns, but also in upturns. And this really can't be underestimated. I have a few younger clients, they're fairly new to investing. And they think kind of discussing your comfort level and risk tolerance and such is a fairly new phenomenon, just over the past decades or so because of the extra volatility we've had, or social media, or the political backdrop. But I like to remind them that this is an issue that investors have been dealing with not only over the past decades, but really centuries. And this is a great example I like to show, because it talks about Isaac Newton's investment in one of the first bubbles of all time, the South Sea stock bubble, and this was in the 1700s. So there is recorded data of what happened back then. You can see in the chart, Newton invested early on in this bubble, made a nice profit, exited pretty happy, but then the greed gland took over. Newton's friends remained in the position. He got anxious. He ended up entering the stock quite high, rode it up a little bit, and then all the way down. Sold it in 3 different tranches, broke. And he famously said, "I can calculate the motion of heavenly bodies, but not the madness of men." So, the founder of Vanguard, Jack Bogle, he used to say, "I have 50% of my money in stocks, I have 50% of my money in bonds, and I'm always worrying about whether I have too much stocks or too much bonds." So investing is always going to be uncomfortable. And one of the main goals is trying to reduce that discomfort as much as you can, not only in up markets, but in down markets as well. So my advice to everyone is to continue this conversation with your advisors about your risk tolerance, about how the portfolio may act in certain circumstances and your comfort level, because it really is important. So, Walt, the next kind of big topic that we covered back then and we'll do now is the difference between the economy and the stock market. So why don't you go into that?
Yeah, absolutely, Jeff. One of the most overwhelming questions we received over the past 6 to 9 months has been, what is driving this disconnect between Main Street and Wall Street, or the real economy and the stock market? And so we're going to dive into that here over these next few slides. But first, let's start off with what we all know, which is COVID-19 was an unprecedented event. And if one economic data point can highlight this takeaway, it's US initial jobless claims. So this is a chart of how many how many individuals in the US went and applied for unemployment benefits. And it goes back, as you can see, to the mid 1960s. And the gray bars represent economic recessions over this time period. And you can see little spikes in the jobless claims throughout those time periods. And then if you look all the way to the right, you see this jump condition up to 3.3 million or so jobless claims during the week of March 18th to the 21st, that third week of March that actually coincided with the market bottom. And I would just remember all of the newspaper headlines, the front pages would be this, the whole front page would basically be this bar. So it just goes to show you how unique this event was. We've never seen anything like it in history. A lot of our clients were sharing the same sentiment. And as a result of that, we saw what the markets decline. And we, from mid-February, February 19th through March 23rd, the S&P 500 fell about 35%. It was the quickest decline of over 20% in the history of the markets. Again, history is what we've witnessed here in 2020. But as you can see in this dark red, it actually, and as Jeff mentioned earlier, it's been the quickest recovery off of those bottoms. So we're witnessing history in that other way. And it just really goes to show you here, there was a little bit over 100 days. Some of these bigger declines, 07, 09, the dot-com bubble, and followed by the recession induced by 9/11, these were extensive declines, and you can see how long it took them to recover. So we really are witnessing the markets are moving very quickly and evolving quickly as well. So we're big data nerds, and we wanted to understand the why behind a stock market recovery, and why the markets maybe are doing so well in what is a very tough economic period. And so Jeff, Gary, and I, the portfolio management department, the investment policy committee, we took a deep dive on some of this data. And the first data point that we looked at was the unemployment rate. And so this is what this chart shows. That blue line shows the unemployment rate going back to the end of the World War II era to late 2019. And you can see that during the recessions, the gray bars, you see the spike in the unemployment rate. And then down below, we dissected the data. So we split it into 3 periods. The first period at the top is when the unemployment rate was over 6%. So the economy was in pretty dire straits. We saw the unemployment rate jump into this over 6% quadrant in April of this year, and it's been there ever since. So something to keep in mind for later. And then the second slice was the unemployment rate between 4.3% and 6%, and that's kind of a Goldilocks. Most of the time we've been there. And then there's another quadrant, the unemployment rate under 4.3%. And this is really in a booming economy. The labor market is tight. We actually did see that in 2019 and earlier this year in January and February of 2020. And so then the right-hand column is what's really astonishing, and the takeaway here is that what are the S&P 500 returns during this various periods? And you can see that actually the higher the unemployment rate, the higher the return for the market. A almost 14% annualized return when the unemployment rate was over 6%. And we've seen that through over these past 5 or 6 months too. And then as you get lower, when you go to the booming economy, the tight labor market, you can see a paltry under 2% annualized return for the S&P. So that kind of that reverse condition there. So let's take a look at another data point there. And the next one we looked at was just GDP, economic growth. And typically, you think that high economic growth would be good for stocks and low economic growth would be bad for stocks. And again, we split up the data into 3 segments. On the left-hand side is periods when GDP growth was over 6%, really strong growth. Then the second component, kind of that Goldilocks growth between 1% and 6%. And then again, periods where growth was flat or negative, so recessionary periods. And you can see from the S&P 500 return, when growth was flat or negative, that's actually when you got the strongest returns, 12% annualized gain, going back to 1960 through earlier this year. And in boom times, GDP growth of over 6%, a negative 5% annualized gain. So it's this condition that it baffles so many investors, especially retail investors, that when economic times are good, that doesn't always mean that stock market returns are going to be good. In fact, it's typically the opposite. So, you know, Gary, I think what this goes to show you is that the stock market's not the economy is not the stock market. In fact, the stock market is really a leading indicator of where the economy is headed, correct?
Absolutely, Walt. So not only has high unemployment and low GDP growth been good for stocks, but stock market recoveries always lead economic recoveries. And what you're seeing here, this data from 1947 forward is showing what happens with the S&P 500 around recession end dates. And it clearly shows that the stock market is a leading indicator, as you mentioned, Walt. And the market always leads fundamentals. And this year, it led fundamentals on the way down as stocks entered bear market territory with record speed, as we saw back in March, and well ahead of the bad economic numbers. And it went on strongly advancing even as the economic numbers continued to decay. As you see there, the data shows the stock market has bottomed on average 4 months before the end of any recession. In addition, despite all the concern around collapsing earnings expectations, the market has also done better when earnings expectations have been low, advancing at an annualized rate of nearly 14% when the expected earnings growth is in the lowest quartile. Notice that 14% annualized is very similar to the 13.7% annualized returns that Walt showed us when unemployment is greater than 6%. And so the takeaway here is that markets anticipate poor economic numbers coming and decline ahead of their arrival. And by the time the economic numbers bottom out, the market has already begun to look through to the other side and is strongly advancing, as we've seen this year. As a result, returns are higher coming out of a market trough. And this leads to what we see on the next page here. That is that the economy and markets so often can feel disconnected. This chart shows the last financial crisis. It shows, and I'm looking at the blue line there, the S&P 500 bank index, which really was the epicenter of that crisis, and how it bottomed when only 8% of the bank failures had been logged. The reason, again, is that the market sees poor economic numbers coming and declines ahead of their arrival. And by the time the economic numbers bottom out officially, the market has already begun to look through to the other side of any crisis. And that's really the history of asset prices. And so here we see banks bottoming before all the associated defaults, the bank failures and delinquencies even started to improve. So always the market is a forward discounting mechanism. And so assets bottom well before asset prices hit the worst levels of a crisis. And correspondingly, asset prices peak well before the best data of any expansion is printed.
But guys, what is going on underneath the surface here is all about sentiment and expectations. And we look at a lot of different sentiment and expectations indicators, but it really comes down to this one key lesson, which I think is probably the biggest lesson of them all. And that is, it's not about whether the outcome, be it economic data, unemployment data, what's going to happen with earnings. It's not about whether the outcome is good or bad. It is about whether the outcome is better or worse than markets expect. So we've showed you some kind of sentiment indicators that we've looked at, over the years to gauge the mood of the market. And heading into 2020 and the fourth quarter letter of 2019, we showed this kind of common one, the CNN fear and greed indicator, and how it was in extreme greed territory at 92. So essentially the market was extremely complacent. They weren't seeing very many risks at all heading into 2020. So essentially there was no margin of safety. So then fast forward to March, COVID hits, you have a 35% decline in the market. All of a sudden this reading goes all the way down to 1. So the expectations were that we were going to head into a Great Depression. And we saw this as well in the Citigroup Economic Surprise Index. And that's the blue line here. And the blue line goes down when economic data comes out that misses expectations. So you see it really did drop off a cliff there, but it went so low that it was kind of the lowest in history. And thus the bar was set so low that going forward, the economic data just jumped over those expectations. And that's why you see this spike in the blue line follow. So essentially, the market was expecting a Great Depression, and what we got was a mini depression. Or, if it wasn't categorized as a depression, it was probably the largest recession of all time. But that wasn't the point. The point was that it wasn't the Great Depression, and thus stocks rallied on that. So Gary, another thing that we looked at to kind of try to decipher the mood of the market and what it was expecting was kind of earnings and earnings expectations. Isn't that right?
Absolutely. And, Jeff, this chart shows what the market was expecting in terms of earnings growth on January the 20th of this year. That's the gold line. As of March the 17th, that's the blue line. The market was pricing in a 45% decline in earnings by the end of 2022. It was also forecasting that earnings would not return to the previous peak within 10 years. And so the point of the chart is that despite all the various issues we've had to deal with as a country, and not just in this downturn, huge wars, GDP and earnings drops, overall markets have a generally smooth ride higher over time. The world has a very long history of solving problems, rebuilding, and fully recouping losses much faster than predicted, even from the worst case scenarios. And nowadays, the government and the Federal Reserve take very quick action, as we saw this year, to reduce the long-term damage to the economy. So the takeaway here is don't bet against 8 billion people waking up every morning trying to make their lives better. The market is always pricing in a lot of the bad news ahead of time. And any transition generally comes quicker than you would expect.
Yeah, and that's why, back in those communication pieces, we showed what happened after the Civil War. We showed what happened to Japan and Germany after World War II, because it is amazing how humans bounce back quicker than thought is. And, another thing that was, quite important to mention now is, where do we stand with respect to earnings? So now the thought is that we might overtake the past highs in earnings in the next 3, 6, 9 months or so. So here, back in March, they were thinking that the break even wasn't going to be for 10 years, and it looks like it could be in the next year or two. So that's how you get a 60% rally in stocks, because that's a big divergence there. And Gary, just to finish up this point, at some point in time, the market gets completely washed out, gets so depressed that even if economic data misses expectations, the market still goes up. Isn't that right? We saw that, right?
Oh, absolutely, Jeff. Markets can easily move higher, even on bad news, when positive monetary, fiscal, or even accounting rule changes are being talked about in the background. And notice here, unemployment claims on March the 21st were almost double what the consensus estimates were saying. That's the middle column there. And so markets shot higher even on the very day of the announcement, because the Federal Reserve had mobilized plans to buy trillions in corporate and high yield corporate or junk bonds, flooding the markets with liquidity. And the federal government was committing to spending trillions in fiscal stimulus and transfer payments. So again, the markets will reward investors handsomely for riding out downturns. And for those with the risk tolerance, even greater rewards for buying as prices go lower when those opportunities present themselves. We're going to look at that soon.
Yeah, Gary, it almost gets to the old adage, bad news is good news and good news is good news when the Federal Reserve and the government is throwing money around like the way it did in late March and early April too.
Absolutely.
So switching gears a little bit, being the data nerds that we are, we always want to look at what happened during previous bear markets. Let history tell us or be a guide as to what we could expect coming out of what happened in February and March. So this is a lot of data on one page, but all this shows is the various bear markets going back to the 1920s, including the Great Depression. And the big takeaway here is that on average, it takes a little bit over 2 years to break even coming out of a bear market, meaning to recover from its previous peak. So a good example of this is October of 2007. You can see down on the bottom right, the third row up, the market had fallen 57% between October 2007 and March 2009. It then didn't recover those October 2007 levels until a little bit over 3 years later, in April of 2012. So that's what we mean by break even. And that 2 years is important for us when we're thinking about portfolio construction, because the ultimate goal within your portfolio, especially if you need your portfolio for spending needs, is we don't want to sell stocks when they're in this drawdown phase. So we want to make sure that there's enough money in high quality bonds that hold up well during these equity market declines to source any spending needs. But also more importantly on this page, we really care about risk management and the tail risk events, not just the average bear market. So if you took the worst 5 bear markets over this time, including that Great Depression, you can see it jumps from about 2 years to break even to over 6 years. And that's really what takes us into the next chart, and which I'm sure all of you all have seen multiple times now. It's the foundation of our philosophy about building portfolios, which is the funnel. And why 6 years is so important is back to that point. We don't want to be sellers of stocks when they're in a drawdown phase. And sometimes that can take up to 6 years. So you can think of this funnel as your total portfolio value at the top in those contributions. And then down below is the required distribution. So if you're giving yourself a paycheck of a couple thousand a year, or let's call it 100,000 a year, then we want the funds needed over the next 5 years to be in that high quality fixed income. And this gives you that staying power, that comfort to embrace stock market volatility, because you know that the bonds will be there that we can sell to source any spending needs. And then at the next tranche, about 5 to 8 years out, we can start taking on an incremental risk. So some higher yielding fixed income segments. And then when we have a time horizon of 8 to 10 plus years, that's when we have the green light to really take advantage of the stock market's long-term growth. So any portion of the portfolio that has that time horizon, we're going to likely allocate to growth securities, primarily stocks in that case. So, Jeff, it is interesting given what the Fed has done with this low interest rate environment. And we're always thinking about evolutions to this funnel, but it's definitely been a great construct to use for our portfolio strategies.
Yeah, I mean, no doubt, Walt. It's obviously built on data, like you showed, but it also has, an extra ability to calm and reduce anxiety, especially in downturns. And hopefully that frees up the investor to think long term and really look at the forest and not the trees. So when you look long term, you think about kind of what is the value of the stock market. And at its foundation, the value of the stock market has to do with earnings, and not earnings over the next 1 year or 2 years or 3 years or even 4 years. The value of the stock market is about earnings well into the future, which makes this chart extremely interesting, because in green, it shows you nominal GDP growth. And the first thing that jumps out here is how smooth it is. So regardless of whether you're looking at the 50s or the 60s or the 70s or the roaring 90s with the tech innovations, GDP growth is fairly stable. Now, the reason why that's important is that in blue, earnings per share follows GDP growth. And when earnings kind of gets too out of whack, deviates too much from the economic growth, then it tends to snap back in line. So when you look at the trend of earnings, which translates into the value of the stock market, it tends to be very smooth as well. And probably kind of the best example, I think, is looking back at the global financial crisis. So you see here in blue, the 1 year rolling earnings per share for the S&P 500. And you look back at early 2007, and the S&P companies were earning around $65 a share. But then you see this massive drop. Over the next year or so, they dropped all the way down to $5 in earning. Again, just massive. But then you look at the 10-year rolling average of earnings, again, going from 2007 and forward, and you see that 1 year blip doesn't even show up. So what this is essentially saying is that even during the global financial crisis, the true value of what you have, the value of the stock market, didn't change very much at all. So when prices go down and the value doesn't change, that is the reason why people always come in and buy. And that's why the market recovers. So Gary, another reason why the markets tend to recover is that humans seem to always change the rules of the game. And we actually talked about this in a webinar in 2019 about the global financial crisis, didn't we?
Absolutely, Jeff. So what you see on this chart is a summer 2019 webinar flashback. And the dark blue line there is the level of the S&P 500 and the explosion higher starting in March the 16th of 2009 when markets realized that the Financial Accounting Standards Board was to formally close the door on the mark-to-market standard. So for banks, this excluded market value changes from regulatory capital, and that was huge. This dramatically increased the value of bank stocks. And we're showing you this again to emphasize that markets are a collection of human systems, not natural laws of physics. And humans can very quickly change the rules, and that dramatically increases the value of assets. And it's so critical to remain invested because humans change human rules to make things better. And humans invented accounting, markets, money printing, and history shows that officials often do anything to stay in power. So on this next chart, we see that just like the Financial Accounting Standards Board changed their mark-to-market rules, central banks have gone from their histories of buying only the highest credit quality assets, like for the Federal Reserve, that would be treasury bonds, to buying this year corporate and even junk bonds. The red line there shows the advance of the S&P 500, and the blue line there shows the asset purchases of central banks like the Fed, the European Central Bank, Bank of Japan. Notice, especially recently, the almost perfect correlation between the red and blue lines. Now in science, correlation is not always causation, but in the human gaming systems of man-made rules, changes of the accounting rules mean mark-to-market can become very quickly mark-to-myth, and central banks can spike asset values by merely printing money. So in that man-made world, correlation is often causation. The point is, leaders will change anything in their efforts to make things better. And that's why it's so important to stay invested.
Absolutely, Gary. And so, you know, this is all fantastic information, but eventually you got to take this information and put it into action. So, well, if you could, you know, talk about the action plan when the market goes down, what the choices are, et cetera.
Yeah, absolutely, Jeff. All this data is great, but it's worthless and meaningless if you can't implement and come up with an action plan from it. So, what we look at is, a few different options here, but what's not on the page is rule number one, which is what we were all saying to each other, Gary, Jeff, and I, in the Investment Policy Committee back in March, which is do not make emotional decisions. During times of ultimate stress, during times of high volatility, which is what we experienced for that 5-week stretch, it is very easy to make mistakes. And there's overwhelming data and research that shows that that is actually the time period where investors tend to shoot themselves in the foot most. So our number one job was to be that emotional circuit breaker between you and your portfolio strategy. And so when you start moving on from there, the first option in a falling market is just to buy and hold, remain complacent. It's okay to have a bit of paralysis and to be scared, but just don't sell any stocks. And so a large majority of our clients did just that. And as such, they were ever able to experience that 60% plus recovery from late March and not shoot themselves in the foot by selling stocks low. The next step is to rebalance the portfolio. And this is what we recommended in March, going in and selling bonds, which have held up well during that time, and buying stocks at these very attractive prices from what we've seen. And in there, that actually enhances returns because you're taking some money from bonds and buying additional exposure to stocks. And the way the math works there is in mid-March, if you had a 60% stock, 40% bond portfolio, you were probably looking at around 55% in stocks and 45% in bonds. So we went in and sold, let's call it 3% or so in bonds and bought 3% in stocks. A small move, but that makes some pretty meaningful impact, especially when stocks have rallied the way they have over the past 6 months coming out of the recovery. The third strategy is to be a bit opportunistic, to actually work to a higher stock allocation. So in this case, move from a 60% stock target to a 70% stock target. And many of our clients were defensively positioned in 2018, 2019, and heading into 2020 earlier this year because of the stock market valuations were a bit expensive and we were late in the business cycle. And they expressed a desire that when we saw an opportunity, let's increase risk. We feel okay increasing our stock exposure. March was a perfect time to do that. So we implemented some strategies to get to that higher exposure, not all at once, but over a span of a few months, and even some ongoing strategies now. The fourth strategy is something that we've been spending a lot of time on at the Investment Policy Committee, and it's a factor of what the Federal Reserve has done. Lowering interest rates to 0% has lowered yields across the board in bond land. So bonds looking out don't have as an attractive a return profile as they have over the past decade and even few decades. And so what our goal at the Investment Policy Committee is for clients that are conservatively positioned, let's say clients that have 40, 50, 60% in bonds, is there a way to take a slice of those bonds, 5, 10, upwards of 20%, and move it into some alternative strategies where you're not taking on the full stock market risk, but you're getting a chance for a higher return, a higher yield, kind of talking about mid-single digits, and we'll continue to expand on that.
Well, it seems like the third one there is likely the hardest on people, to increase stock risk, when stocks are falling and falling rapidly. So how can people think of that and be comfortable with that and kind of think and know that most likely that's a great strategy?
Yeah, exactly. The big question was, how do you have such conviction that you should be buying stocks at this time? It almost felt stupid to say back in March, and it usually does feel stupid. It seems wrong. It doesn't seem right to be buying stocks when they're down 30, 35%, but that's exactly what you should be doing. It's what the data says. And yes, there's a chance that it can go lower in the short term, but over time, it's going to reward portfolio and your returns greatly. So let's look at some of the data. Again, a lot of data on this page, so let's break it down. On the left-hand side, that percent from high column shows you the different increments of when markets fall from their most recent high. So to put it in perspective, the 2020 decline was 30 to 35% from high. And then the next 6 columns over show you the returns after the markets had fallen to that level. And the main takeaway here is that when you start looking out 1, 3, 10 years out from these steep declines, stock market returns look really good. And the more you decline in stocks, the greater the opportunity. So I think this just brings up a really good point about volatility in general. Stocks offer investors a long-term return of about 10%, but it's not for free. The price for admission of those great returns is volatility. You have to be able to handle the volatility, and you have to expect the volatility. And once you expect the volatility, you can embrace it. You can make it your friend. So in March, Gary, Jeff, and I, and the rest of the team, we were licking our chops. We loved it in a sick way because we knew that stocks were getting attractive again, and we felt that we could really put money to work. And so if you have that mentality of expecting it, you can then embrace volatility and then buy stocks when you see these declines. Be opportunistic. So Jeff, another data point that we always look at in terms of trying to build action items or an action plan out of the data is what we refer to as the equity risk premium, or are investors being compensated for the risk that they take on in stocks?
Yeah, I mean, it means so much. And, clients who have been with us for a very long time know that we're always looking at the expected 10-year annual returns for the major asset classes and asking ourselves, what is it telling us? So what you see in front of you is what we were looking at in January earlier this year. So you see kind of working left to right there, bonds, we were expecting roughly 2% annual returns looking forward over the next 10 years from January. In United States stocks, not much better, about 2.5%. For international stocks, much better. International developed at 7% and emerging markets at 8.9. So if you take the kind of the normal blend of those stock indexes, you get the dotted line there. And so we're assuming about 4.2% annual returns that stocks may provide investors over the next 10 years, but that's only about 2.2% exact, over what bonds are likely to produce. And that 2% spread really didn't excite us. So that's why, we were fairly negative on stocks, earlier this year and a couple of years before that. It's because this premium was so low. Well, let's fast forward to what the numbers were telling us in March. You can see the spread really widened out to the point where we were estimating that stocks would return roughly 4 to 5% annually, more than bonds over the next 10 years. And in mid-March, when the market really bottomed out, that spread was closer to 6 or 7%. So that's some serious compensation for taking on extra risk. And that's what made us a little bit more positive on the market in difficult times. So fast forward to today or November data, you see that spread has tightened back up again. So call it around 3%. And at the 3% level, given the volatility, we're about neutral on the market. But most importantly, this is how we think that investors should view the market and make decisions accordingly, because we think it's really helpful. So Gary, another chart that we showed people back in our communication pieces was this one here that talks about the benefits of slowly working in and slowly buying a market that's falling. So why don't you explain this?
Yeah, absolutely, Jeff. So this chart puts some real numbers on what Walt was mentioning regarding the power of buying into declines. So shown on the chart, that Blue Mountain area there, you see how much $100 purchase each month, and that's the constant red horizontal line, starting in 1929 would be worth 25 years later. So $100 invested in 1929 would be $300 by 1954. Not bad at all. But as the market fell from 1929 to 1932, notice that each one of those $100 purchases realized even greater gains by buying into the teeth of that darkness. And Jeff always mentions that fear as the price for those gains. Those purchases would have turned into over $1,200 for each $100 invested. Now bring that forward to just this year. Each $100 purchase made around the lows of March would now be worth $162, or a 62% increase. Walt mentioned that. Again, this shows you the power of buying into declines versus running from them. So on this next chart, Walt also mentioned alternatives to bonds. And the blue line on the chart is the 10-year Treasury yield and its descent from the early 1980s with yields in the double-digit range to yielding less than 1% today. And really, that rate drop explains why bonds have done so well over the last 40 years, because interest rates just kept dropping. But with current rates where they are, it's hard to imagine, absent highly negative rates, bonds doing so well on a forward basis, especially if another stock market decline keeps rates pretty much where they are. So that can easily create a scenario requiring alternatives to bonds. And that's why we've been working on various options and alternatives to bonds in our investment policy committee.
All right. Well, thank you, Gary. Thank you, Walt. We've covered a lot of information in this one. This is kind of an extra long webinar. So let's go through some of the summary points before we wrap up. First of all, we talked about how important it is to know yourself and position your portfolio based on how you may react, especially in downturns. We talked about how it's not about if the economy or other factors end up being good or bad. It's whether they're better or worse than expected. We are big believers, and we've said this often, that markets cannot be forecasted in the short term, but they can reasonably be forecasted over longer periods of time. So take a long-term perspective, take a look at what it's telling you, and make choices accordingly. In the end, we believe stocks will reward you and certainly can be trusted. Hopefully, with some of the information today, we've kind of shown that. And thus, stock market declines can turn into exciting opportunities rather than reasons to panic. And we ended up throwing a little extra into this webinar about low interest rates, and we didn't unpack it very much. But in the years ahead, in 2021, 22, and ahead, we will likely be discussing a lot more about alternatives to bonds given these low interest rates. So that's all we got for you today.
Yeah, so thank you all so very much for joining us today. We so very much appreciate our clients, and we're always happy to talk with you. Call me, call Jeff, call Walt, or call your service team if you need to discuss anything that we've talked about, or if you just want to comment or have a question. We always enjoy hearing from you.